Welcome back, everyone. This is part two of the informational series. So, in the first part, we talked about candlesticks and bar charts and what they were, and we glimpsed on what I'm going to talk about today, but I didn't give it enough significance for how important it is, and that is going to be time frames. So, time frames are so important when you're trading. You never just going to be looking at one time frame when you're trading a forex pair or a futures contract. You're always going to be looking at multiple. And if you ever watch one of my Sunday live streams, you'll see that I have a macro, a micro, and an intraday charting. So first, what is a time frame? So obviously, each candlestick is the length of time, whatever time frame it is. So if we're looking at here, you can see there's the 1 minute, the 2 minute, 3 minute, 4 minute, 5 minute. You see it goes down up to an hour, and then you go to hours, and you go to days, and you go to months. So there's all these different time frames we can look at, and each one's going to show us a different candlestick chart. Same indices, same color, all of that stays the same, but the only difference is each candlestick prints whatever amount of time that is. So each time frame tells us different things. When I'm in intraday trading positions, I like looking in the smaller time frames, but I'm not just looking in the smaller time frames. Something I really failed to understand when I first started was how important the macro time frames really are. So that would be looking at the weekly, the monthly, the daily, and like the 4 hour. So these are the can be to be considered the macro time frames. And really, these time frames tell you a lot of what the institutional banks are doing. So the big thing is that the institutions, like the giant banks, are really the ones moving the market. But you're not going to see Goldman Sachs going in and buying on the 1 minute time frame. That's not what they do. They leverage their positions in these really large macro time scales because they have such heavy leverage. They can't put that big of an order in such a small chart. So a lot of the stuff you see where you see big flows is from institutions. So this is going to be them. This is where they're going to put their sell stops, their buy stops, and yeah. So obviously something I neglected when I first started was looking at these higher time frames, because when you're looking at it intraday sitting down, it doesn't really look like your daily candle or your weekly candle is moving a lot. Like in the grand scheme of things, it's like, oh, we barely moved this entire week. But you don't realize how much price action is actually being moved. And if you can build a higher frame narrative from these high time frame charts, you'll have so much more success in your trading because you'll have a higher time frame bias. And if you have a bias on which direction you believe the market's going, your consistency in trading is just going to go up so much. So really, if I could go back to when I first started, that would be one of the first things I tell myself, is just really look at these higher time frame charts, because they're really telling you the full story, and they're telling you where price is actually going to be moving. A lot of new people have the misconception too that us day traders, our single accounts collectively worry are what moves the market, but that's just not true. We do not have enough capital in our accounts to actually move these candlesticks. A lot of what you see, we're kind of like the wicks of the candles, but we're not really doing all of the actual moves. These explosive moves, like you see here, we have like an explosive 1 hour candle. This is going to be an institution, some kind of institution, heavy leverage, heavy money entered here, and that's what pushed the market higher. And my main concept of trading is I'm trying to figure out where the institutional order flow is going to go so I can get my order in that wave. Because I'm not going to be the one to move the market. You're not going to be the one to move the market. But these big institutional banks, their orders are going to be what pushes the market higher and lower. And once you understand that concept, you realize how important these higher time frames are, and you really can catch the higher time frame. And now instead of getting like a 10 pip move, that you're talking like 70 pip, 50 pip, like huge moves that you're going to be catching, like 50 points on futures instead of like 10. Like all your positions, your risk to reward, you can keep it smaller, but your reward you can make higher. So instead of doing like 1 to 2, now you're talking 1 to 3, 1 to 5, sometimes even like 1 to 10 if it's a really good trade. So if you can learn to read these higher time frames and understand where institutional order flow wants price action to go, it's such a game changer when you start trading. So yeah, time frames. Time frames are what is really built on all of this. If you look, you have time and price, right? That's all you have on a chart. That's all I use on a chart. So candlestick was showing you the price. The candlestick itself is showing you the time in which you're looking at. And putting these two together, there's basically so many fundamental concepts you can build. And every concept I trade off of is built off of these two things, which is time and price. So yeah, for anyone just starting, I would, TradingView's a good app. You can use Webull, Robinhood. Just go on these apps and go on charts and just look at either the NASDAQ or the S&P and just look at these higher time frame charts. So you want to go, you're going to start out by going into like the weekly chart, right? And see where are we weekly. Well, obviously, if you look at NASDAQ, we're way up, all-time highs. We're breaking all-time highs every day, which is what I was saying is usually when we're breaking all-time highs, you just kind of keep a bias that they're going to keep pushing price higher, and we've seen that to hold true the last week and a half. So, again, still keeping that bias. And then you really want to build a setup from going to a higher time frame down to a lower time frame. So if we have this setup, the weekly we're going to be long, but we're still going to keep going long. Going to the daily. See, does the daily chart support that idea? And you're going to say the same thing. It looks like, yeah, we're still going up here. I haven't taught you guys anything about order blocks or fair value gaps yet. Those are still a little advanced for complete beginners, but same thing. It's really good. You just want to look at these charts. And a lot of people think like, oh, the daily chart moves so slow, like I can't trade that. But there is no slow and fast. Like time's the same on every chart. It's just the amount of candles being printed on every chart's different depending on the time frame. But price is still moving to the exact same points. So some people when they first start trading too, they're like, oh, it's like the 1 minute time frame's too fast for me, or the daily time frame's too fast for me. But in all reality, your setup, if it's based off a higher time frame, price is still going to that same place. So there really shouldn't be any fear of a lower time frame or a higher time frame. But yeah, so same thing. You're looking at the daily, and then now we're going to drop into the 4 hour. What's the 4 hour telling us? Again, 4 hours coming up to these all-time highs. But when you have all-time highs like this too, the weekly and the daily aren't telling us much other than it looks like price is going to keep going up. So we have to build our setups more off of these 4 hour and 1 hour time frames. And again, same thing here. You kind of can see more now. It doesn't look like the chart's just going straight up. You can see we have some equal highs here we're targeting. We have some retracements and then explosion again. So then you can go into the 1 hour time frame. The 1 hour time frame is a really good bellwether time frame. When you get like a closed candle for your setup on the 1 hour, that's usually really reassuring that you're on the right side of the market. But again, same thing. You can see like in general, the 1 hour time frame's up a lot. But you can see the retracements here too. And a retracement would be if price goes up higher, we have to retrace. So you come back down and then you go up again and then you retrace. So retracements anytime the market goes to a high and then price comes back down into that range and then goes back up. I'll make another video about what retracements are and the different types of market conditions we have. To give you a little glimpse, there's consolidation, retracement, and reversals. And then there's one more I'll talk about in the next video. But those are all good things to look at. But right now, honestly, if you just learned what the candles were in the last video and now you're looking at higher time frames, just go through your brokerage or your charting, whatever you chart on, and just go through your time frames. Start at the 1 week, down to the 1 day, down to the 4 hour, the 1 hour, then all the way down to eventually you're going to get to the 15 minute. Look at the 15 minute, see what that's telling you. And then if you're not trading now, the 1 minute, 5 minute aren't going to really tell you much, but you can just see how much more price action's in those candles. So yeah, I think to wrap up this lesson, I just say don't undermine higher time frames, because higher time frames are where institutional order flow is going to occur, and that is where you're going to be able to put your orders there and ride the price with the banks, and that's where you're going to get the highest returns with risking the smallest amount of money. So I hope you guys found this video insightful, and I will see you guys in the next one.